Hi everyone, welcome back to the channel. Yesterday we saw the earnings reports from Microsoft, Google and Meta, and I have to say that their results have made me extremely bullish. Let's quickly go over the key numbers and understand why these reports made me increase my exposure to Meta and Nebius by buying more shares. First of all, the most important metric of the reports is cloud revenue, which showed insane growth. Microsoft Azure cloud business grew 40% year over year, while Google Cloud grew 34% year over year. And the most striking thing is that both companies say that they are facing capacity constraints, meaning they can't meet all the demand. And they both say that this period of capacity constraints will continue for at least the next few quarters, and personally, I think for the next several years. This is important for anyone worried about an AI bubble. Microsoft and Google are actually building compute capacity that is already in demand, not just for some hypothetical future demand. Margins have also remained rock solid, despite both companies ramping up their capex over the past 2 years. Microsoft reported a gross margin for Microsoft Cloud, including Azure, of 68% this quarter, slightly over than 71% in the same quarter last year. Google Cloud, which is smaller than Azure and behind in margins, managed to increase them significantly, going from 17% in Q3 2024 to 23.7% this quarter. These numbers prove that the hundreds of billions of dollars being invested by big tech are already paying off. This is extremely bullish for the entire AI ecosystem, for chip makers like Nvidia, AMD, and Broadcom, for hyperscalers like Amazon, Microsoft, and Google, for neo-cloud companies like Nebius and CoreWave, and for anyone involved in building data centers. There are many other highlights from the reports. Talking about Google, it just had its first ever quarter above $100 billion in revenue, hitting $102.3 billion. And also Google Search is far from dead, growing 15% year over year to $56.6 billion in revenue. Talking about Microsoft, it posted $27.7 billion in net income, and 2025 will be its first year exceeding $100 billion in total net income. And they also reported that the total value of cloud contracts signed but not yet realized increased by 51% to $392 billion. Now, moving on to Meta. There is a lot of positive news, and I think they crushed earnings, even though the stock is down nearly 10% now. Meta continues to be the fastest growing Mag 7 company, excluding Nvidia, which is in a league of its own, and they reported $51.2 billion in revenue, and that marks the first quarter in their history above $50 billion, up 26% year over year. They expect sales for the current quarter to be between $56 billion and $59 billion, which will represent roughly 20% year over year growth at the midpoint. So, why did the stock get hit? There are two main reasons. First, net income dropped sharply due to a $15.9 billion one-time accounting adjustment for future tax liability. And most importantly, spending is growing even faster than revenue. Total capital expenditures more than doubled year over year to $19.4 billion, and the company signaled that total expenses are set to grow at a significantly faster pace in 2026 than 2025. For hyperscalers like Amazon, Microsoft, and Google, this level of spending is understandable. They sell capacity as a service. But for Meta, this spending is about investing in the hope that it can train advanced models and reach what Zuckerberg calls superintelligence. It's still unclear exactly what Zuck means by superintelligence or how it will be monetized, but he believes aggressive investment is the right strategy, since the potential upside far outweighs the risk. As he said, I think it's the right strategy to aggressively front-load building capacity. That way, if superintelligence arrives sooner, we'll be ideally positioned for a generational paradigm shift in many large opportunities. If it takes longer, then we will use the extra compute to accelerate our core business. And I agree with Zach. Yes, Meta spending 37% of its revenue on capex might seem alarming, but he will likely find ways to make these investments pay off, improving targeted advertising or other areas. Plus, Meta trades at just 22 times forward PE ratio, making it too cheap to ignore. And right now, It's my favorite Max 7 stock. Now, about Nebius, the reason yesterday's earnings make me extremely bullish and made me realize that I don't know enough of it is that cloud demand continues to outpace supply, and this situation is likely to persist. Recently, OpenAI announced it's purchasing an additional $250 billion worth of Microsoft Azure cloud service. And Microsoft, as we know, already has a $19 billion deal with Nebius, which show that it's really capacity constrained. And this announcement makes me think that Microsoft might increase the value of its deal with Nebius. Arkady, the CEO of Nebius, said that the Microsoft deals is just the first of many agreements with hyperscalers, and after hearing Zach's words, I'm increasingly convinced a deal between Nebius and Meta is next. Azure and Google Cloud, much bigger than Nebius, are growing 40% and 34% year over year. Considering this, I can't help but imagine the numbers Nebius will generate. In the last quarter, Nebius revenue grew 106% quarter over quarter and 625% year over year. I'm confident Nebius will continue growing at triple-digit rates for the next few years. To wrap it up, yesterday earnings were exceptional. The drop in Meta stocks makes no sense to me, and Nebius is still early in its journey but destined for massive growth. That's why I increased my position in Meta and Nebius. So that's it for today. I hope you enjoyed the video and see you next time.